Top beginner-friendly options. Strategies with a small $1,000 account. Had a Fight told you that some of the safest options strategies are not the flashy turn $500 into $50,000 overnight trades you see all over social media, but boring, repeatable strategies that aim to slowly grow a small account, month after month. Because here's the truth most beginner traders learn the hard way. If you start with a small account and take massive risks, you usually end up with an even smaller account. But if you focus on probability, consistency, and risk management, a $1,000 account can become the training ground that teaches you skills capable of compounding for years. In this video, we are breaking down the top beginner-friendly options strategies for small accounts, including which strategies are safest for beginners, the average realistic monthly returns, estimated annual compounded returns, how much capital each strategy requires, and the biggest mistakes beginners make that destroy accounts. And stick around until the end, because I will also show you which strategy I believe is the absolute best starting point for complete beginners with limited capital. Section 1. The reality of a small account. Before we talk strategies, we need to talk about expectations. One of the biggest reasons beginners fail in options trading is because they start with unrealistic goals. A lot of new traders think, if I can just make 20% every week, I will be rich. But professional traders do not think like that. Most experienced options traders focus on protecting capital consistency, risk-adjusted returns, probability, and avoiding catastrophic losses. Here is something most YouTube gurus will not tell you. A consistent 3% to 5% monthly return is already extremely powerful and compounded over time. Let us look at what that means. If you start with $1,000 and average 3% monthly compounded, that becomes roughly 42.6% annually. And if you average 5% monthly compounded, that becomes approximately 79.6% annually. Now, obviously, no strategy wins every month. There will be losses. There will be drawdowns. There will be frustrating periods. But the goal is not to get rich instantly. The goal is survival and long-term growth. Because surviving long enough to gain skill is what separates real traders from gamblers. And with only $1,000, risk management becomes even more important. A single reckless trade can wipe out 20%, 30%, or even your entire account. That is why the strategies in this video focus on to find risk high probability setups, small consistent gains, and beginner-friendly mechanics. Strategy 1. Cash secured puts. This is one of the most beginner-friendly options strategies ever created. Here's the basic idea. You sell a put option on a stock you would not mind owning anyway, and in exchange, you collect premium upfront. If the stock stays above your strike price, you keep the premium. If the stock drops below the strike, you may be assigned shares at a discount. Think of it like getting paid to place a limit order on a stock you already wanted. That is why many long-term investors love this strategy. Now here is the catch. Traditional cash-secured puts usually require more capital, because you need enough money to buy 100 shares if assigned. So with a $1,000 account, you will need cheaper stocks or ETFs. Some beginner-friendly examples might include Ford SoFi smaller ETFs, lower-priced dividend stocks. Example, let us say a stock is trading at $9. You sell a put with an $8 strike price. You collect $20 in premium. If the stock stays above $8, you keep the $20. If the stock falls below $8, you may buy 100 shares at $8. But since you collected premium, your effective cost basis is lower. Average monthly return. For conservative traders, roughly 2% to 4% monthly, or approximately 27% to 60% annualized compounded. Now remember, these are estimates based on disciplined risk management, not aggressive speculation. Why beginners like it: generates income, easier to understand, lower stress than day trading, encourages patience, teaches probability, biggest risk, the stock can collapse, and suddenly you are forced to buy shares that are worth much less. That is why beginners should only sell puts on quality companies they would actually want to own, not random meme stocks. Section 3. Covered calls strategy. 2. Covered calls. Covered calls are another beginner favorite. But there is one important issue. With only a $1,000 account, your stock choices are limited, because you must own 100 shares first. Still, cheaper stocks can make this strategy accessible. Here is how it works. You buy 100 shares of a stock. Then you sell a call option. In return, you collect premium. If the stock stays below the strike price, you keep the premium. If the stock rises above the strike, your shares may get called away for a profit. Essentially, covered calls allow you to generate income from stocks you already own. Example, you buy 100 shares at $8, total investment, $800. Then you sell a call option and collect $15 to $30 in premium. That premium lowers your cost basis, and if repeated consistently, it creates an income stream. Average monthly return. Most conservative covered call traders aim for 1.5% to 3% monthly, approximately 19% to 43% annualized compounded. Why beginners like it? Simple concept. Lower volatility income generation, good for long-term investors, easier emotionally. Biggest risk: your stock can drop sharply. The premium collected may not offset losses, and your upside becomes capped if the stock explodes higher. Still, for cautious beginners, covered calls can be one of the safest introductions to options trading. Quick pause. If you are enjoying this video and want more realistic trading education without the fake Lambo trader nonsense, make sure to like this video, subscribe, and turn on notifications, because this channel focus is on practical strategies, risk management, and long-term wealth building, especially for beginners starting small. Now let us move into the strategies that require even less capital. Section 4. Credit spreads. Strategy 3. Credit spreads. This is where options trading becomes much more capital efficient. Credit spreads are incredibly popular among small account traders because they define risk. That means you know your maximum possible loss before entering the trade, and that is extremely important for beginners. There are two main types: bull put spreads, bear call spreads, but the concept is similar. You sell one option and buy another option farther away. That purchased option limits your risk. Example, bull put spread. A stock trades at $100. You sell the $95 put, buy the $90 put. You collect a credit up front. If the stock stays above $95, you keep the full premium. If the stock crashes, your maximum loss is capped. This makes credit spreads far safer than naked options selling. Why small accounts love credit spreads? Because instead of needing thousands of dollars, you might only need $100, $200, or $300 of risk capital per trade. That makes it ideal for a $1,000 account. Average monthly return. Disciplined spread traders often target 3% to 6% monthly, roughly 43% to 101% annualized compounded. And before you get excited, remember, higher return potential usually means higher risk. Beginners who overtrade spreads often blow up accounts quickly. Common beginner mistakes: trading too large, ignoring earnings events, holding until expiration, trading low liquidity options, revenge trading after losses. Why? This strategy is powerful. Credit spreads teach probability, risk management, position sizing, patience, emotional discipline. For many traders, becomes the gateway strategy into more advanced options trading. Section 5. The Iron Condor Strategy. 4. Iron Condors. Iron condors are basically two credit spreads combined together. This strategy profits when a stock stays inside a range. You are essentially betting that the stock will not make a huge move. And surprisingly, markets spend a lot of time moving sideways. How it works: an iron condor combines a bull put spread and a bear call spread. This creates a defined profit zone. If the stock stays within that zone until expiration, you keep the premium. Why beginners find it attractive? Defined risk, non-directional, high probability setups, consistent income potential, average monthly return. Conservative traders often target 2% to 5% monthly. approximately 27% to 80% annualized compounded. The problem: iron condors can look deceptively safe. You may win many small trades in a row, then, suddenly, one major market move wipes out weeks of gains. That is why adjustments and risk control matter tremendously. Best environment: iron condors tend to work best in home markets, sideways markets, low volatility environments. They tend to struggle during market crashes, explosive rallies, major news events. For beginners, this strategy can still be useful, but only if position sizes remain small. Section 6. Long calls and long puts. Strategy 5. Buying calls and puts. This is the strategy most beginners start with. And honestly, it is also the strategy that destroys the most accounts. Buying calls means you believe the stock will rise. Buying puts means you believe the stock will fall. Sounds simple, but options buyers face several problems: time decay, volatility collapse, directional risk, emotional overtrading. The biggest issue: most options expire worthless. That is why beginners who only buy cheap lottery ticket options usually lose money consistently. Average monthly return. This varies wildly. Some months, plus 50%, plus 100%, even plus 300%. Other months, 50%, 80%, or complete losses. That inconsistency makes long options extremely difficult for beginners. Why most small accounts blow up? Because traders start chasing huge wins. Instead of risking 2%, 3%, or 5% per trade, they risk half their account on one option contract. That is gambling, not trading. When long options can work strong trend momentum breakout setups, major catalysts, high conviction trades, but for consistent beginners, this is usually not the best starting strategy. Section 7. The most important rule: position sizing. Now here is the part most beginners ignore. Even the best strategy in the world fails if your position sizing is terrible. This is where accounts survive or die. A good rule for small accounts is: never risk more than 3% to 5% of your account on one trade. With a $1,000 account, that means risking roughly $30 to $50 maximum per trade. I know that sounds small, but that is how professionals survive losing streaks. Because losing streaks happen to everyone, even elite traders. The goal is staying alive long enough for probability to work in your favor. Another critical rule: avoid overtrading. Many beginners think more trades equals more money. Usually it means more commissions, more mistakes, more emotional decisions. Quality matters far more than quantity. Focus on high probability setups, patience, liquidity, risk control, consistency, and remember, your first year of trading is less about making money and more about not losing all your money. Section 8. Which strategy is best for a $1,000 account? So which strategy is best? If I had to rank the best beginner-friendly strategies for a small account, here is how I would break it down. Number 1. Credit spreads. Best balance of capital efficiency. Defined risk probability flexibility. Excellent for learning discipline. Number 2. Cash secured puts. Great for long-term investors who want stock ownership. Especially useful for patient traders. Number 3. Covered calls. Fantastic for generating income, but limited by account size. Number 4. Iron condors. Useful once you understand volatility and risk management. Number 5. Long calls and puts. Highest excitement, but also highest beginner failure rate. The real secret: the strategy matters less than risk management, emotional control, position sizing, patience, consistency, because even mediocre strategies can work with discipline, and great strategies fail without it. At the end of the day, a small account is not a disadvantage. It is actually one of the best learning environments possible, because it forces you to develop discipline, patience, risk management, and emotional control, and those skills matter far more than account size. Remember, most successful traders did not become profitable overnight. They survived long enough to improve, so focus less on getting rich fast and more on becoming consistently profitable. because consistency is what eventually creates freedom. If you enjoyed this video, make sure to like, subscribe, and comment below. Which options strategy are you most interested in trying first? And if you want more beginner-friendly trading content covering option strategies, risk management, passive income trading, wheel strategies, credit spreads, and realistic account growth, subscribe now and I will see you in the next video.